Hello, my name is David Bailey, and I'm recording this video for MBA 280, which is an operations management class at Sacramento State University. This is a linear programming article at GE Capital from the journal Interfaces, titled GE Asset Management with Genworth Financial and GE Insurance use a sequential linear programming algorithm to optimize. You can see the reference here below. And this paper was especially interesting to me because when studying modern portfolio theory, I've thought that risk being equal to variance was a gross oversimplification. There's so many factors affecting the risk-return trade-off. So my interest in a mathematical modeling of portfolio optimization is not so unique. Many people hope to time the stock market or identify technical or other models which will allow them to make unlimited sums of money in equities and securities. So GE Capital has experimented with models to create an algorithm which attempts to allow sequential linear programming, iteratively to address the changing risks faced in the market. And this means that asset and liability managers previously used immunization strategies based on Macaulay's duration formula to match equities for risk optimization, and those models are based on a linear assumption. And you can see that here in the project overview, the goal for linear modeling. And the attempt of immunization is to match liability duration against asset duration to immunize against non-systemic risk in the market. And the goal of portfolio theory is to create an efficient frontier with a risk-return trade-off. Any point along the frontier would then be the most return available at a given level of volatility, or the variance of the returns. GE created a team of multidisciplined professionals, including actuaries, IT professionals, portfolio managers, etc., and they were going to approach the formerly intractable problem of creating a model which would efficiently create a better return. An economic model using the variance of economic surplus adds constraints to match the duration and convexity within a given parameter. This economic surplus is the difference between market value of assets and liabilities, a multi-factor risk framework rather than a cross product of variances. So you can see from the chart from the paper that based on the linearity of the models, only certain returns are available. But notice if we use a nonlinear risk contour, that a better return is available at each risk level. And the paper was written in 2003 when there was far less computing power than there is now. They discussed running a Windows NT server with 4 gigabytes of RAM. So in order to prove that their algorithm that they were developing, the ALM, was more efficient than the existing models, they ran a quadratic programming solver with the MATLAB software, and they were able to vary the number of assets between 40 and 160, and they calculated that this would take about 37 hours to generate a single portfolio, or one point along the efficient frontier. And that's computationally impractical because you need hundreds of those points in order to really describe the efficiency frontier. So, and apologize for reading this slide, the key rate duration constrains iteratively. Previous portfolio managers had to use trial and error to capture a best result. And taken directly from the paper is a summary of their algorithm here. the results are that the QP solver was able to come up with an efficient frontier, but the new algorithm could analyze 1,500 securities in 200 seconds, and then they began to compare the quality of the results. And in just a fraction of the time, the SLP algorithm was able to provide them with more portfolio options, which created a higher return, lower risk at a given return, or in some cases both. And then it was the goal of GE to make this available via a web server to their internal customers. So anyone who was creating a portfolio under the umbrella of GE Capital might have access to a tool that would look something like this, describing the efficient frontier and showing them a portfolio that would be available. So the net result is that the algorithm creates a more efficient risk frontier and allows a better immunization against risk. So any firm which was using an older model or was unable to immunize in this way would not be able to realize the same return for a given risk profile. And short-term trading with incomplete information sets always results in a loss, either sooner or later. So in terms of the benefit to the economy, identifying and quantifying risk does take away some of the variability, but ultimately it's a zero-sum game where someone is buying a security and someone is selling a security. So someone loses and someone wins with every trade. Now, asymmetric information can create inefficiency in the trading markets. So this closer tying and understanding of risk measurement allows trades to happen more easily, more efficiently. They are greased, if you can think of it in that way. And these same algorithms that were developed by GE Capital can be used for any supply chain problem, logistics, manufacturing operations. Thank you. I also wanted to touch briefly on some of the financial results that GE has seen over the years 2003 and 2004. They were returning 2 basis points higher using the SLP algorithm than they would have been. Obviously they had access to the old models, so they could do a direct comparison. And GE and subsidiaries has a little over 100 billion in assets. The estimate is that over a 5-year period, $75 million of revenue could be generated, which would not have been available without the multilinear programming.